Hey everybody, I want to talk about investment property. So I called my good buddy Brian Patton, who's somebody I know that's bought a lot of investment property, and we get a lot of calls of people thinking about buying investment property. Do they form LLCs? Do they bring other people? Do they buy second homes together? Do they rent out their current house and go buy a new house? And so Brian's written a book called Mailbox Moolah. You need to get it. It's on Amazon, right?
Yeah.
It's on Amazon if you're interested in investment property. But I wanted to pick his brain a little bit today about some of the things that people ask me questions about, and I wanted to see what his answers would be. So Brian, if you're trying to figure out if that house is a good buy, a residential rental house, what are the factors that you take in consideration? What are you looking at? What helps you get to a decision that I want to investigate further?
Well, obviously, it's all about the numbers. You know, in the market we're in, sometimes it's hard to find the rental properties that make a lot of sense. We've almost outstripped to some degree how much rent you can get with the value of the property. But you know, you can still find properties in what I used to focus on was the lower end housing. I say lower end, $300,000, $400,000, which is lower end in this area nowadays. But you can still find some of that, even in Forsyth County. You know, I saw one the other day. It was a $200,000 house, very small. But you know, it's all about how much money you want to put down. Obviously, the more money you put down, you basically buy cash flow. You used to be able to do this for 10 or 15% down and cash flow a deal. Now I think it's higher. It's probably 20, 30% down. You're going to have to put down to actually make cash flow.
So if you were buying a house, you would want to make sure it cash flowed immediately. You'd put enough money down to make it cash flow.
Yeah,
or break even.
I would never do a deal that's a negative cash flow. Doesn't make a lot of sense. But there are, in my opinion, there are two types of investors. You got cash flow investors and net worth investors. Net worth investors are more people that are buying single family houses, and they're making a little bit of cash flow, but not a lot. But they're anticipating appreciation and paying down the debt. And that's how eventually, over a 20-year period, you can make a lot of money. Cash flow investors are more apartment buyers, duplex, quadruplex buyers, and what they're really more focused on is the monthly cash flow that it produces. The main reason for those differences is that cash flow investors are selling to other cash flow investors. Whenever you buy a property, you have to look at the exit strategy. When you're buying a single family home, most likely your exit strategy is to sell to retail, somebody wants to live there.
Right.
So the cash flow is not that important it's not important at all to the person that's going to live there. So from appreciation, you typically get better appreciation from single family homes than you do multifamily because you're selling to the end user that doesn't care about the cash flow.
Okay, so if I'm thinking about renting my current house that I live in, so I bought my first house, I'm ready to buy my second house, and I'm thinking about if I can cash flow that house and I don't need the cash out of it, the equity out of it to go buy another house, would you say, hey, consider renting that house?
Absolutely. That's how I got my start. I think when I first met you, I had a house over in Lilburn, and I was up late one night and saw one of these real estate gurus, and they started talking about how
how to get rich
with cash flow. So I started calculating, hey, if I keep this house three or four more years and rent it out, I'll make about what I'll make just selling it. So I decided to keep it, and I think that's one of the best ways to get into rental real estate is to buy a house as your primary house, stay in it a few years, keep it, and then rent it.
I tell young families that all the time. It's incredible because then you turn around and you're 10 years down the road and you got 3 or 4 houses, and now you got $500,000, $700,000 net worth if the appreciation's good.
And what most people don't get is, those 10 to 20 years flies by. We're a little bit older gentlemen, and next thing you know, you wake up and it's 20 years later. So if you have a plan and a process to buy one or two houses every couple of years, over a 20-year period, you could amass 10 or 15 houses, and that creates talking about retirement. Forget the retirement from your job. You buy a house that's say $400,000 right now. In 10 years, it's probably going to be worth twice that easily.
Right.
So that times 10, you're talking about $4 million right there in just increased appreciation. Not to mention your debt reduction, and your rental cash flow over the years. And of course, taxes is the biggest benefit, in my opinion.
Tell me about that. What's the tax advantage?
The biggest tax advantage is depreciation. They call it cost recovery now. But depreciation, you basically take the value of the house, not the land, but the value of the house that's sitting there. The government allows you to depreciate the value of that over 27 years. So you basically divide, let's say that $400,000 house or property, $300,000 of it is structure value.
Mm-hmm.
So you divide that $300,000 by 27, and that gives you the amount of deduction you get off your income tax. So a lot of your rental income, a huge portion of it, property taxes, interest you pay on the loan, depreciation, a lot of your income is tax sheltered.
Right. So the easy way I tell everybody is let's say you've got a rental property and you're renting it for $2,500 a month and your payment's $2,500 a month. Basically, on your tax return, it's going to show a loss because that's a depreciation. So that you take that off of your income. So even though the cash flow piece didn't cost you anything, you may get a loss on your tax return to help you not pay as much taxes. So I'm telling these young families, you got two people making $50,000, $60,000 a year, and you got $100,000, $125,000 in income, and you get to depreciate that property a little bit. That's a savings. It's real money.
The other interesting side of it is just from appreciation, your appreciation can typically really offset your interest payment.
Right.
Because let's say you buy that $400,000 house and it appreciates 3% a year.
I
Actually,
think
probably
it's
more than
probably
that.
more than that.
I mean, over the last 20 years in our area of Georgia, you're probably looking at 7 or 8% over those years.
So let's say
every
5%
year.
average.
Even 5%. I mean, you're paying a 6-7% interest rate right now. So over the long term, most likely that appreciation is going to outstrip your interest costs. You still get to write off your interest, but it's not really costing you anything because of your appreciation in the asset.
So then when you go to sell that house, then you got a whole nother issue, right? Because now you got to pay tax on that profit because you don't live there. It's not your primary.
You don't have to.
All right. So
1031 exchange,
right.
Also called a Starker exchange or like-kind exchange. It's part of the 1031 is part of the IRS code that allows you to exchange for another property. Simply put, you sell your property through a process of hiring something called an exchange intermediary, which is just a company that IRS allows to do this. And you sell that property, you go buy another property, and you don't have to pay capital gains. In effect, you can do that your entire life. Give it to your kids when you pass, and they don't pay any capital gains under the existing tax code because their adjusted cost
right,
basis.
okay.
That's it. Their adjusted basis moves up to when they receive it, that whatever the value is. So if you continue to do those two 1031 exchanges, you don't have to pay
but
capital gains tax.
Even if you don't do that and you hold that property for 10 years and you pay it and you make money, then you're only paying long-term capital gains,
Exactly.
right? Which right now is 20%,
Right.
which is a lot lower than most everybody's regular income, right?
Right.
So it's still a heck of a deal.
Absolutely.
Right? But if you live in that house, let's say I go and I go buy my second home and I rent my old one out. So then I have to have proven that I lived there 2 out of the last 5 years.
For it to count as your primary house.
So I can rent that house up to 3 years and still sell it and not have to pay tax on it.
And you can do that every 2 years.
So I can test the market, right? I can test the market to see if I want to be a landlord. All right, so now let's go about being a landlord. People say, I don't want to be a landlord. What do you tell them? I'm going to rent my house out, my first house?
I've had people, I used to teach a lot of real estate courses, and I'd have people say, well, I don't want to change out a toilet. Well, I've never changed. I've owned a lot of houses over the past 30 years. I've never changed out a toilet. I mean, you hire somebody to do that. There's a lot of handymen that'll do that for you. They say, well, what if the roof caves in? Like, what? If the roof caves in, well, that's, if it's a tree falls on it, then you have insurance. And roofs don't just cave in. So, people sort of throw out these what ifs all the time.
Right.
My advice is if you think about being a landlord, buy early, buy often. Sort of like voting.
I love that.
So start as soon as you can, buying what you can, and don't get caught up in the minutia of the what ifs. I got all kinds of stories in my book Mailbox Moolah about mailboxmoolah.com. I've had all kinds of stories about things that have happened to my properties, but you got insurance. You roll with it, and it's not as scary as it seems.
Well, I tell people you just need a handyman, right?
Yeah, absolutely.
If you had a handyman, then that handyman, if he can't fix it, then he's got a electrician friend or he's got a plumber friend. He can help you manage that process.
Other thing to say, I don't want somebody to call me at 2 a.m. Well, my phone's on silent at 2 a.m. Nobody can call me at 2 a.m. but my family. So, yeah, nobody's going to call you at 2 a.m. if you set your phone up like that.
All right, so let's say I have an expense. The hot water heater and the dishwasher go out, and I got to go spend that money. Is that a good thing or bad thing on my tax return?
Well, yeah, it's a good thing, I guess. I mean, it's expense that you write off.
So that's just even less money on paper showed on that property, and in actuality, I'm enhancing that property.
Usually you're enhancing it.
So for when I go to sell, or if I go paint it, or whatever I do, right?
Right.
Are you teaching your kids that? Are you trying to teach them to go buy property and do like you did?
Actually, my daughter helps us with some property management now.
All right, what about Airbnb? Some people have talked about, hey, I want to buy this house and turn it into an Airbnb. What's your thought on that?
Well, the Airbnb market has gotten a little soft because everybody thinks they want to be an Airbnb property owner. The issue Airbnb is it's very high management intensive. So
like running a hotel almost.
It is. I mean, so instead of paying, a property manager 8 to 9% for a single family house, you're going to be paying 25 to 30% for management on an Airbnb. So that cuts into your profit a lot. But I will say the Airbnbs, if you get a good one, can produce a little bit better return. But you're looking at single family housing 5 to 6% return. Airbnb's probably 7 or 8% return. So it's not that much better return, but you can get a little bit better return. But it's a little more risky, in my opinion, obviously because the return's better. But a lot of the Airbnb market is not where you could turn that into traditional long-term renter. So you have to be careful about that. If it doesn't make it as an Airbnb, can I turn it into a traditional rental? If you can do that, then it's probably worth the risk.
So a lot of that is location, right? Depends on where you're buying and what's going on. Or when you're considering if you were going to consider renting your current house out, what are some of the things, or how would a normal person go about figuring out what the rent would be, or if is it a desirable area? How should they think about that?
Yeah, probably most important is school districts. I mean, that's huge when you're talking about renting properties out for residential use, especially the higher end homes. So that I would say that's the number one thing.
It's school district.
School district.
Yeah, I've got a rental that's in the Milton School District, and it just pops,
And the other thing is you're talking about, how do you find out the rate? Call a local real estate agent. Excuse me. Call a local real estate agent. Look in, a lot of people putting rentals on Facebook Marketplace. So those.
Well, where do you put your rentals?
Facebook Marketplace is about the only.
Marketplace.
Back in the day, I used to put classified ads, but you don't get those. Those aren't even around
Our
anymore.
Kids don't even know about that.
But Facebook Marketplace. There's some rental sites.
How about Zillow?
You can do it on Zillow too. You can list as owner on Zillow, stuff like that.
Okay, thank you, Brian, for giving us that information. Appreciate you tuning in. Hey, if you have a question about rental real estate, feel free to email me, call me. If you need Brian's information, I'll get it to you. Brian loves talking about it. He's taught a lot of people about it. He's written a book about it. He's had a radio show about it, so he's really into it. So give me a call and let me know if you got any questions.